the Dow has had 13 straight up days. The last time the Dow had 13 straight up days, you know when it was? 1987. What happened in 1987? The stock market crashed. Now, I don't want anyone out there to say, oh, Gareth's predicting a crash. I'm not necessarily predicting a crash. What I am saying to you is this is a time when you see everything going up and you want to FOMO into the market, when you want to be like Bitcoin and be like the individual you probably were at 68, 69,000, sometimes this is a time to sit back and be patient. Because again, instead of buying at 68, 69,000 on Bitcoin, a lot better to buy right now at 29, even if it goes down, much better than 69,000.
The European Central Bank has raised interest rates for the 9th consecutive time on Thursday. However, there is now speculation about a possible pause in September, as inflation pressures show some signs of easing, and concerns about a recession continue to grow. The ECB has been trying to combat a historic surge in prices by raising borrowing costs, with a total increase of 425 basis points since last July. The main reason behind this move is the fear that rising costs and wages in an exceptionally tight job market could sustain price growth. Following Thursday's 25 basis point hike, the ECB deposit rate has reached 3.75%, its highest level since 2000, even before euro notes and coins were introduced. Meanwhile, the main refinancing rate was set at 4.25%. ECB President Christine Lagarde has changed the practice of guiding markets for the next decision and stated that the future course of action is uncertain, despite the central bank's determination to tackle inflation. On another note, Gareth Soloway shares his insights on interest rates, inflation, the stock market, and cryptocurrencies. So, let's sit back and listen to Gareth's views on these matters.
Yesterday, Fed raises by 25 basis points. 25 basis points, totally expected. What we weren't expecting was a more dovish tone. For instance, Jerome Powell said, and this is something where I saw the dollar decline instantly when he said this, he said, we realize as the Federal Reserve that there's a lag in monetary policy, meaning that they're raising and they've continued to raise, but there's a 6 to 12 month lag before it hits the economy. All right, so right off the bat, that's important to understand. All right, so they're saying that, which means they're going to be more hesitant. It's a hesitation in further rate hikes. Now, if we see inflation start to uptick, they may have to go back to hiking. But right now, to me, that tells me there's a wait and see attitude. ECB this morning raises 25 basis points, says the same thing as the Fed, says they're data dependent. Okay, so a couple things to go over here. This morning, we got GDP numbers, 2.4%. Better than expected. This economy, folks, while you do have certain economic factors that are weak, the main headline numbers, jobs, as well as GDP, very, very strong. The consumer, while growing more and more in debt, is still spending money hand over fist. Credit card debt now north of $1 trillion, the highest of all time. The amount of money that people are spending on housing alone is at an all-time high. It's at 40%. 40% of income being spent on housing, yet the consumer is saying, you know what? We are just going to continue to spend money, probably partly due to the stock market going up, makes them feel richer, and partly due to the fact that we've become children. Everything's about bailing us out. The Fed will bail us out. The government will send us checks. No big deal. Let's just spend, spend, spend. After COVID, we had this urge to just spend very hard. Once you start spending money and living a little bit freer, we know it's very hard to cut back to where you were prior. All right, a couple other things. So GDP coming in better than expectations at 2.4%. Expectations were 2%. Durable goods orders coming at 4.7% this morning. That was better than expected as well. However, this is the kicker. What wasn't better than expected, if you take out transportation from durable goods, guess what? It was lower than expected at just 0.6%. So again, this is where it is, right? This is what kind of market we're in. We're in a market that's euphoric. We're in a market that wants to continue up, that people had money on the sidelines. They want to chase things like stocks in like Nvidia, or in this case, Meta today after the earnings from Meta. I'll talk about that in a minute. But then we do have underlying economic data that's a little bit weaker, a little bit weaker. Now, one number that wasn't weaker was jobless claims today. About 6 weeks ago, we saw jobless claims spike to about 260,000 or so for 3 weeks in a row. We've come right back into 220,000. Today's number, 221, lower by 7,000 jobs from previous week or the previous week. And again, folks, what that tells us is there's not a lot of firing. There's not a lot of people filing for unemployment. And that's what that number is, folks. The initial claims are how many people are claiming unemployment. And so the reason why you pay attention to this is if that starts to spike, and usually the kicker is this, I'll tell you what to watch for. Watch for 300,000. If we get above 300,000, that's major trouble for the economy. As long as we're below 300, it's not that bad. It's not that bad at all.
While the overall inflation rate has remained steady since October, the underlying price growth is at historical highs and there are indications that it might have even accelerated this month. ECB President Lagarde mentioned that the risks of second-round effects, which refer to inflationary pressures from higher wages leading to further price increases, have not worsened since last month. However, the concern arises from the fact that with record low unemployment, there are fears that workers may demand higher wages to offset the real income loss due to inflation. As a result, many investors and analysts have been anticipating another interest rate hike by the ECB in September, pending the release of autumn wage data. In addition to discussing inflation and interest rates, Gareth delves into the cryptocurrency market, providing analyses on Bitcoin and Ethereum, and offering intriguing price predictions. Now, let's return to the video to hear more from Gareth.
The fact that we're seeing inflation, meaning food and energy, spiking higher, and remember, yesterday in the stream I showed you guys the chart of gasoline at 52-week highs. Oil not that far away from 52-week highs. Month over month, both are up 15+%. So month over month inflation jumping substantially. Year over year is almost flat now. If we also looked at the DBA, which is the agriculture ETF, it's at 52-week highs, up big this month. So again, by the way, look at orange juice. Orange juice skyrocketing as well. Not that that's a big one, but I think it's just another commodity that is going parabolic. These are going to have an impact. And if we're saying now, and the Fed has said yesterday, this was big, the Fed's people said no recession. No recession. And if that's the case, and we're going to start to reaccelerate in the economy, then you have to expect inflation to reaccelerate because demand for commodities is going to rise, as well as if people are doing better, demand for all products are going to rise. So everyone was so happy about the consumer price index last month. Get ready, guys. It's going to start upticking. And the key is going to be is if it upticks, how does the Fed react? Do they have to go back to raising rates? Do they say, hey, we aren't going to cut till 2025, which is kind of what they're saying right now. And by the way, yesterday Jerome Powell said that. He said, don't expect us to cut till 2025. That's a lot of time where rates remain very, very high. But remember, after yesterday, we're at a 22-year high on interest rates, 22 years. We have Bitcoin still trading below the range. As long as Bitcoin's below the range, it is vulnerable to a drop. Okay, so again, yes, it's had a couple up days, but remember, these couple up days are coming on the back of the Fed saying what they're saying here and all these other things. So again, the fact that we're not back above 29.9 to 30,000 is a little problematic. Doesn't mean it can't happen, but again, that's a little bit problematic. Watch again, are we creating a bear flag here that could divulge into a bigger move down? Going back to over here, I want to show you the Ethereum chart. Okay, so let's go to the Ethereum chart real quick. The Ethereum chart is remaining in this channel, downside vulnerable to this level. This would be the equivalent of that 27,000 level hit on Bitcoin. So if we get down to about 1770 or so, that's your support. That's the level you want to hold on Ethereum. If it breaks below that, trouble brewing. As long as it stays at or above that level, honestly, just like Bitcoin, Bitcoin stays at 27 or above, it's okay. Not that big of a deal.
In the financial markets, the sentiment towards rate hikes has shifted significantly. While there was full anticipation of another rate hike a few weeks ago, now only a few foresee such a move happening in September. Currently, the markets are pricing in just 17 basis points of hikes for the rest of the year. The decision for another hike in September depends on whether there are unexpected upward surprises in inflation numbers. Despite existing disinflationary pressures, the prevailing approach is now to maintain interest rates at their current level for a sustained period, with some policymakers cautioning against raising rates excessively. Meanwhile, the U.S. Federal Reserve has recently raised borrowing costs and kept the door open for further rate hikes. However, Federal Reserve Chair Jerome Powell did not provide clear hints about the September meeting. Economic indicators show a continued deterioration in business, investor, and consumer sentiment, along with signs of softening in the services sector, despite a likely strong summer holiday season. The weakening economic conditions, coupled with the erosion of real incomes due to inflation, could lead to a faster decline in inflation than expected, potentially limiting the ECB's scope for action. ECB President Lagarde acknowledges that the era of continuous rate hikes may be drawing to a close. However, uncertainty remains regarding the future path of interest rates. As the discussion continues, viewers are encouraged to share their thoughts on whether the incessant rate hikes will come to an end in the comments section below. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.